Very good afternoon to all of you. I, Sanjib Pattnaik, welcome you to this particular session of our course, that is Management Control System, coded as MMPF 003. We have already discussed the various aspects of management control system, like the getting acquainted or introducing ourselves with management control system, the framework of management control system. Apart from that, we have also seen the various tools and techniques that have been used for the management control system. Today we shall enter into the block 4, the last block of this particular course. That is, we shall focus on how management control is done in some special organizations. So block 4 has been termed as management control in some special organizations. So when we say special organizations, we shall try to limit our focus on firstly the service organizations. Second, we shall look at the various types of project organizations, and along with that another unit will tell us about the multinational organizations, how management control is done in this prevailing business in a globalized atmosphere. And the final section will be looking at some other organizations, how management control system is applied. So our focus today will be, that is unit 13, management control in service organizations. Now here we shall try to focus mainly on the banks, the mutual funds, you can say, insurance companies, as well as the non-profit organizations. And our focus will be based on the Indian context. So let us begin our session on management control in service organizations. What has happened? In India, we have seen over the ages the main area of generating income or where work was done is the agricultural sector. Now, up till the 1950s, you can say mostly the Indian industry was centered around agricultural business. From 1950 onwards till the mid of the 20th century, or we can say till 1990s, the manufacturing sector made rapid strides in India. It tried to come up with big industry under 5-year plans, along with the various private organizations, and mainly we tried to follow a Russian model of industrialization. Now, after 1990s, when the India's business boundaries were opened up, then came the term called as LPG, that is liberalization. Then you have globalization, and Using this liberalization, globalization, what and globalization, uh, what we tried to do? Na, service sector came into being the upper hand in the business sector in the Indian context. So up to mid 20th century, workforce in India was mostly engaged in agriculture, as we said, up till 1950s, and up to 1990s it was in the manufacturing sector. After that, service sector has come up or has made rapid strides, and it has overtaken the agricultural sector as well as the manufacturing sector. So during late 20th century, service sector has made rapid strides. So when we are talking of liberalization, that means the export import policies were made easier. Privatization, that means the industries, the service organizations were open to private players. And globalizations, that means multinationals can also do business in India, and Indian companies also did business in other nations. So this LPG process made the service sector to come into the forefront. Now what is happening? Our gross domestic product, GDP, a major part of that is coming from the service sector. Now, why this has happened? What led to this rapid strides or rapid growth in the service sector? Here we can pinpoint some of the areas like increase in literacy rate. In earlier days, the literacy rate was very poor in India. The number of schools, colleges, technical institutions, medical colleges, etc. were very, very less. But now we find the educational institutions, starting from the young kids till a person is turned or transformed into a highly skilled individual, you have abundance of institutions in various fields. So these institutions have led to an increase in literacy rate. Another is increase in disposable income. Now what is this disposable income? The salary of the workers or the employees, what was happening? It was growing day by day. From the salary, we spend a portion on the basic needs or the basic requirements like the housing, clothing, and the food. In earlier days, these three used to eat away much of the salary, or the salary was too less, and whatever it was going towards these three areas. But nowadays, what is happening? Apart from meeting the housing, the clothing, and the food expenses, the daily requirements of a individual or a family, much of the income is left in the hands of the individual, which becomes disposable income. That means the individual can spend it or save it as he or she likes it. Thirdly, we saw rapid technological advancements. Think of a bank 20 years back. There were no computers. If we go to the banks, what we are finding there? Now, any transaction we did, a big book or register will be brought where our account will be searched for and it will be opened. And there the accountant will record the kind of transaction we are making at the bank. So it usually took a very large amount of time. It consumed time. Thereby, the number of people or individuals who can be served during a given period of time became very less. But due to technological advancement, now you see we can go to any bank branch. Immediately the teller will feed that into the computer instead of searching for all the registers, etc. And the transaction will be over within few seconds or 1 minute, 2 minutes, like this. Or there is also no need for going to the bank branches also. You can take the help of the ATMs, the deposit machines, etc. So all this technological advancement has made rapid strides for the service sector. Better communication. We know nowadays communication is instantaneous. Any kind of information is passed on from individual to individual or from place to place anywhere in the world within the blink of an eye or even much less time. But in earlier days, communicating an information was taking huge amount of time. Mobility of workforce. In earlier days, the focus was how to work in certain industry which is nearby to the home place. But nowadays, there is nothing called as home place. The educated, technically advanced workforce, they are moving from cities to cities, either inside the country or to different countries, that means different locations, and the transportation has become very fast. The connectivity has become too large. Anywhere you can go at a faster pace. So workforce are mobile. We have seen in order to increase our volume of services, we can also outsource them. That means instead of creating and keeping a huge workforce ourselves for generating the services, we can outsource many of our requirements. Thereby, we can serve our clients, but the overall requirement is not an headache for the company. Another thing is, or important thing is, change in lifestyle pattern. Nowadays we are finding a car, a house, vacations, savings for kids education, savings for future requirements, post retirement, etc., are to be taken care of by the individual during his working days. So, in order to maintain the kind of lifestyle which one can maintain during his working days, uh, they have to have that kind of income also. So, this lifestyle pattern is putting a pressure on the disposable income, which brings the service sector into the forefront. Now, what are the various characteristics of service organizations? When we are talking of a conversion system, uh, generally we say inputs are sent to a conversion process, that means transformation process, which gives you an output in terms of either products or services which are of much higher value. That means value addition is done by getting outputs, that are the products or services which are required. Now, product and services differ in their characteristics. Now let us see what are the characteristics of particularly the service. Absence of inventory. Uh, Suppose we are producing certain item called as pencil. It is a product. Now we can store the pencil. We can keep it in shelf. But think about a service. Service cannot be stored. That means it cannot be inventoried. It has to be consumed at the same moment in which it is generated. So we say one of the basic characteristics of service is absence of inventory. Second important characteristic of service is difficulty in quality control. Now when we say quality takes into account many aspects into consideration. Suppose I say quality is the measurement aspect. Suppose the pencil we are manufacturing should be of 8 centimeters. What will happen? We can produce all the pencils exactly equal to 8 centimeters. Now think about a service. Think about getting the same service at 2 different places or 2 different locations or 2 different companies. Now, definitely we'll have a different feeling for the service when we are looking at it, maybe from either the same person at 2 different points of time or at 2 different locations, etc. So what we say? Quality control is difficult in case of services. That means variability is more in services. Services are labor intensive. If we look at products nowadays, you will find the factories, the production lines are more mechanized nowadays. When we say mechanized, use of machines, use of robotics, use of computers, etc. are too high. The workers are there only to operate the machines. So the number of laborers are dropping down. If you look at service industry, apart from having the various kind of machineries that is required to generate the service, you also need a large number of workers or laborers. So we say service organizations are labor intensive. Next is for generation of services, we can have multi-unit organizations. From the very beginning, we saw we cannot inventory the services or we cannot transport the service from one place to another. But think about a product like pencil. Have a plant inside India at a particular city. From there, you transport it to various parts of India. That means you can do with a single unit plant, or you can have four different plants at four different regional areas. So here, with a minimum level of units, the organization can manage the products. But for services, you need multi-unit centers. Think about a bank. Inside the city where we are living or the place where we are living, you may find, suppose in a city, the number of SBI branches will be around 15, 20 in a small city, or in a big city like metro city, the number of SBI branches may be running into 100 or 200 units. So the service organizations may be small, but the number of units are very, very high. Another last characteristic that we have taken for discussion is, suppose there is a immediate demand for a certain kind of output. Think about the output as product. We know that products can be inventoried. That means we can keep it, that means produce it and keep it in the shelves. When this unforeseen demand comes forward, we can take it out from our inventory and we can satisfy the demand, the immediate demand that has come up. But for services, it is very difficult, because with the number of workers and the infrastructure you have, the amount of services that can be generated is more or less fixed. Since it cannot be inventoried, you cannot say that immediately I will take it out from the shelf and I will satisfy the particular services demand. Apart from these characteristics, you may have a number of other characteristics. But specifically, service organizations have these 5 important characteristics at least. Now, we shall focus on the financial service organizations, which comes into the picture when we talk about money or monetary assets. The focus of ours at the beginning, I said, is in Indian context. So Indian financial system is the, we can say, aggregate of all the financial companies, organizations that work inside the boundaries of the country. So Indian financial system comprise of the commercial banks like SBI, like HDFC, etc. Financial institutions. Here we can take the example of mutual funds, insurance companies. Most of us are well acquainted with insurance companies. Then we can talk about capital markets. Now, capital markets uh, are the markets for the equities, bonds, or long term assets of an organization, or this capital market, they help to provide liquidity to the already existing long term securities of various organizations in India. That means they help for uh, having a marketplace for buying and selling the items. In earlier days, we had fixed marketplaces as capital markets like Bombay Stock Exchange, like Bhubaneswar Stock Exchange, etc. But nowadays, due to the rapid advancement in technology, you have the online platforms. You can sit anywhere and you can do the transactions of the capital markets. Now, these financial service organizations, they deal with monetary assets. Now, what are these monetary assets? I'll tell you, for example, let us think about a fixed deposit in a bank. I deposit a certain amount, suppose rupees 10,000 in the bank. The bank will give me either a certificate in paper form, that means material form, or a online form, that means dematerial form. Now this fixed deposit, after its tenure is over, I can get back my money, or also I can surrender my fixed deposit within the tenure and get back my money, but with less interest. So when we are talking of monetary assets, the assets which can be converted into money or monetary units readily or at a very fast rate are called as the monetary assets. So here you can also have the equity shares, you can have bonds, you can have bank fixed deposits, the mutual fund units, etc. Now, the impact of transactions. The impact of transaction of financial service organization will never be felt immediately. Today we take the decision for a transaction. Now whether that transaction is beneficial to the organization or is generating losses to the organization can only be seen after a fair amount of time. So the impact of transactions in monetary assets is felt after a long period of time. One important aspect here is risk and reward. Now, what is risk? Uh, think about a fixed deposit in State Bank of India. Think about a deposit in certain kind of uh, we might have heard cheat funds. Now, SBI might be paying around 5.5% per annum as interest on the fixed deposit. But the cheat fund will be promising you that they will pay you around 50% interest per year. Now you think SBI is giving you at 5% interest rate, the cheat funds are promising you at suppose 50%. Now immediately one will be attracted toward the a cheat fund. But the money that we have entrusted to the State Bank of India is more or less 100% safe and secure. But in case of the cheat fund, there is huge amount of risk that the company may close down, take away our money and may vanish. So the risk is how much losses are expected in the future from a monetary asset. Lower the risk, lower is the reward. When we say reward, let us take it as suppose the interest. The amount that we get on our monetary asset for parting with a financial service organization for a certain period of time. We give our money to the financial service organization. After a certain period of time, we get back the amount along with some extra. That extra is the reward. In State Bank of India, the risk is very less, so also is the reward. But think about the cheat fund. What they said, we will pay you 50% interest per annum. They're alluring you with a huge reward. But think about the risk. The risk is also very, very high. Now, the financial service organization in India are regulated by certain regulatory authorities, mainly the RBI, that is Reserve Bank of India, that look after the functioning of the banks, commercial banks, SEBI, Securities and Exchange Board of India. They look after the functioning of the capital markets and money markets. And regarding the insurance company, the regulations are given by IRDA. So, apart from this, any other regulation as given by government are also have to be adhered to. But mainly RBI, SEBI and IRDA, they regulate these various components of the Indian financial system. RBI for commercial banks, SEBI for the capital and the money market instruments, IRDA for the insurance companies. Now let us look at everybody have a fair knowledge about banks. Now, what are its characteristics? Now, banks are seen as profit centers. Why profit centers? Uh, we might have heard about SBI during the last quarter has made rupees 1,200 crore rupees as net profit. Now, where from the bank is getting profits? Think about a situation. We go to the bank and make a fixed deposit. Now, this fixed deposit is supposed for 5 years. The bank promises us to pay 10% per year as interest. Now, for this 5 years, my money is at least locked with the bank. Or if we look from the bank side, we may say that the bank is going to use my money for at least this 5 years. Bank will be giving this money as loan to some other required party. Our disposable income was positive, so with the surplus or the savings, we make fixed deposits. Similarly, industries are there which require money for running their operations. They take loans. These loans come from this money for which we have made fixed deposit. Bank pays us 10% interest, but it will be taking around, suppose, 15% interest per year for the loans it has given to the industries. Now, what is the spread here? Now, 15% is what bank is getting, and for that it is paying us 10%. So 15 minus 10 is 5%, which is left with the bank. That is called as the spread. This spread is the bank's profit. There may be certain other adjustments for getting this spread. There may be also some kind of activities like some person trying to liquidate their fixed deposit before its maturity. That means if I made a fixed deposit for say 5 years, but I require the money at the end of third year, I can liquidate it. That means get my money back by surrendering the bank fixed deposit. But the 10% interest that was supposed to be given to me by the bank will be reduced. But this money which I am liquidating, the bank may not be prepared for that, for which it has to keep some liquid amounts or reserves always at hand so that it can meet such kind of scenarios. Second is interest rates. Now, the interest rates in the Indian economy is given by Reserve Bank of India. Reserve Bank of India prescribes what should be the minimum rate of interest for a given period of time. Suppose we say the PLR, the prime lending rate as given by RBI is, suppose, per year it is 5%. That means if the bank takes money from RBI, then it is at 5%. So what banks will do? Now they will fix how much to pay for the fixed deposits, that means advances, A, the deposits, and how much to take from the loans or advances. Now, this gap will form the interest rate gap. So the interest rate spread is a Herculean task for the banks. Third is volume of deposits. Now, banks' profit depend upon the spread which it gets from its deposits as well as loans and advances. There may be scenarios where the bank may be deposit heavy. For example, suppose a bank is located inside suppose a educational university. There what we find, either the student fees will be coming or the salaries of the employees will be kept in the bank mostly. Think of another branch of the same bank which is located in a marketplace. So there the customers are mainly looking for loans and advances so that they can utilize that in their business. So some bank branches can be deposit heavy, some bank branches can be advances heavy or loan heavy. NPAs. Now it was one of the most important aspect which was hammering the Indian economy. Non-performing assets. Now what is a non-performing asset? Suppose an industry has taken a loan from the bank and the industry does not pay back the principal as well as the interest at the scheduled times. So what is happening? The advance which was given for a asset which was to generate income for the bank is not performing. So we say it as non-performing assets. So banks should always look out for how to reduce their NPAs. If NPAs get higher, then it is very bad for the banks. Another is expenses of the banks. Now banks do have expenses like the staff payments, like the technological fees, like the expenses for technological upgradation, etc. Joint revenues. We have bank branches nowadays all over the places, all over India we can say. The word or the phrase that goes on with the bank is anytime banking, anywhere banking. So if I have a bank account at SBI in my hometown, I can do transaction at any place in India because all the branches have been connected with the central server. So here the question arises, who will take the profit? Is it the branch where the customer's account is there, or is it the branch where the customer has done the transaction, or is it the headquarters that will take the profits? So it is for the bank management to decide regarding the joint revenues. Another is transfer prices. Sometimes what happens? A bank branch may be running out of funds. So it may ask another branch which is surplus with funds that you transfer some funds to us. Now here the question is, at what price, what transfer price the funds will be transferred from branch to branch? Will it be decided by the branch managers or is it by the headquarters? Now, the various risk characteristics of banks that is found is, first is credit risk. When we say credit risk, we are talking of suppose we have given a loan or advance to a certain industry and industry is not paying us back or the customer is not paying us back. So our expectation is not met. So that is the credit risk. Second is interest rate risk. We know that the bank make profits out of the spread between the deposits and the loans. Suppose the bank is having a deposit rate of 10% and loan rate of 15% per annum. The spread is 15%. Now, in order to become competitive, sometimes the bank reduce the loan rates. Suppose it comes down to 12%. Now what happens? The spread is now 12 minus 10, that is 2% only. The effect may not be immediately felt, but it will be felt later on. Third is foreign exchange risk. Nowadays we know in this globalized world, the banks not only deal with the local currency, that is Indian rupees, but they also transact in foreign currencies. And there is always a exchange rate, that is how much rupee we pay for suppose $1. That is the exchange rate between the US currency and Indian currency. Suppose I say rupees 80 per dollar. That means to purchase $1, I have to pay 80 rupees to the bank. Similarly, bank may also say that to buy $1, that means bank will buy $1 at 78 rupees. Now here the spread will arise, the 2 rupees. But suppose the exchange rate changes, the spread will also change. If it is having an adverse effect, that is the foreign exchange risk, or we say value at risk. We also face the liquidity risk. Liquidity risk is When we try to keep our money as deposits with the banks, we may have fixed deposits, but at time of need, we may immediately require to break the fixed deposit or surrender the fixed deposit or liquidate the fixed deposit. Now the bank should be ready for such kind of scenarios. Now these scenarios are done by two kind of reserves as directed by Reserve Bank of India. One is cash reserve ratio CRR and second is SLR statutory liquidity ratio. So these two rates the bank have to maintain. Apart from that, while judging the risk, Indian banks also follow a camel's model. What is it? The capital adequacy. Now, anyone or any organization taking advances, whether its capital position is adequate or good. Second is asset quality. That means wherever it wants to invest, will it actually perform, generate income? What is the management of the industry? What is the earlier earnings and expected earnings of the particular industry? Now, is the industry having liquidity? That means able to pay the immediate payments, and whether the operating systems in the industry is good enough. So this camel's model is adopted by Indian banks. Now let us have a look at insurance companies. What are their characteristics? Before starting anything, all of us know that whether it is our life, whether it is our vehicle, whether it is our house, we have various types of insurances. As we see, the various types of insurances are life insurance and general insurance. In life insurance, we have two kind of things: whole life insurance and term insurance. Now, an individual who is preferring a whole life insurance has to pay the premiums over the life period or till he or she lives. After their death, the accumulated or the sum assured along with bonus are paid to the beneficiary. We also have term insurance. What happens in term insurance? Now, for a certain period of time, we go on paying premium, suppose for 10 years. After that, we will not get back any kind of the maturity benefits or bonuses. But within this 10 years, if anything happens on toward thing, that means towards the life, then will be paid, our beneficiary will be paid with the amount that has been assured by the insurance company. Apart from life insurances, we also have general insurance. Just like I said, the car insurance, the bike insurance, the house insurance, etc. These insurance companies are regulated in India by IRDA of 1999. Now here the focus of the Indian government is insurance penetration and insurance density. When we say insurance penetration, that means the premium amount that is being generated out of insurances by the individuals or the organizations, how much it contributes towards GDP. When we talk of insurance density, we are talking of how much proportion of people in India are having insurances. Now, in insurance, how do we control the management? First is product pricing. It includes the various features like tax saving policies, future policies, growth policies, etc. While making insurances, the company looks at the age, gender, risk profile, and accordingly premiums are fixed. Then the acquisition cost, servicing cost of the policy. We also look at lapse probability. That means whether there are any chances that the person or the organization making the insurance will not go further in the insurance. That means not make any payment. Also, we look at probability of payment. Then we have to adapt to or adhere to income taxes and statutory regulations. And for the insurance company to exist, what should be the required rate of return that is to be generated? We also look at sales performance. Nowadays, you have seen the insurance agents are fighting out in the market like anything to sell their policies. Then we try to control the expense in terms of asset liability management through the investment process, risk management, and internal control. The third service organization we shall look at is mutual fund. Now here what happens? We pay our money by purchasing the various units of mutual funds. Now this money is pooled together and invested according to the various mutual fund schemes. And this is managed by highly skilled, technically as well as with experience fund managers. They are invested in both capital market, that means long-term market, as well as money market. So here we look at the investment and risk policy, whether you are going for balance fund, growth fund, or you want a stable income. We also look at the compliance manual along with any kind of untoward situation in the future, what is the contingency plan, and the reporting framework, how the fund has been utilized for the customers. And for the last one, non-profit organization, some peculiar items are capital fund, the annual subscription as paid by the members, life membership fund as paid by the members. Government also gives grant either in bulk or on a regular basis, that means every year. Anyone wanting to join comes as an entrance fee. We may also get donations from various other organizations. Now, legacy and endowment fund. Now, the fund accounting is done since the name says non-profit organization. Fund accounting is done for only knowing what is the income and expenses, and it is management by the trustees who are usually not paid. So, the management control system, the financial services organization have a big impact on the whole economy. So, with this, thank you.